It's 2 a.m. You're sound asleep. But there's a small group of people who are wide awake right now, watching screens, analyzing data, making moves that will make them significantly wealthier by the time you wake up. I'm not talking about gamblers or day traders. I'm talking about the ultra-wealthy, the people with real money who understand how the game actually works. And right now, they're orchestrating one of the largest wealth transfers in modern history, so quietly that most people have no idea it's even happening. Here's what should terrify you. While average Americans are feeling good about their 4% savings account, the wealthy are positioning themselves in assets that could generate 10x, 20x, even 50x returns over the next decade. I'm Brad, and today we're pulling back the curtain on exactly what the rich are doing with their money right now, and how you can stop getting left behind. The savings trap. Let's start with an uncomfortable truth your bank doesn't want you to know. Your savings account isn't saving you. It's slowly destroying your wealth. But Brad, I'm earning 4.5%. That's the best rate in years. Congratulations, you're losing money slower than before. Here's the math that should make you angry. If you're earning 4.5%, but inflation is 3.2%, your real return is 1.3%. That's before taxes. If you're in a 22% tax bracket, your after-tax return is 3.51%. Subtract inflation, and your real purchasing power grows at 0.31% per year, 0.31%, you're running on a treadmill, barely moving forward. Meanwhile, the S&P 500 averaged 10% returns over the past decade. Gold is up 80% since 2019. Bitcoin, despite volatility, is up over 400% from 2020. The wealthy aren't comparing returns to savings accounts, they're comparing to opportunity costs. Every dollar in cash earning 4.5% could be earning 15%, 25%, or more in the right assets. They understand something fundamental. In an era of money printing and technological disruption, cash isn't safety. Cash is guaranteed depreciation. What the rich are buying. So what are wealthy investors actually doing right now? First, they're accumulating gold at levels we haven't seen since 2008. Central banks purchased over 1,000 metric tons of gold in 2023, the highest in decades. Wealthy individuals and family offices are increasing allocations significantly. Gold, isn't that outdated? That's exactly what they want you to think. While you dismiss it as a boomer investment, they're stacking it quietly. Why? Because they understand our current reality, government debt that can never be repaid. Central banks trapped between inflation and recession, the dollar's dominance being challenged, money supply expanded by trillions. In this environment, gold isn't nostalgia. It's insurance against monetary chaos. But here's the sophisticated part. They're not just buying physical gold. They're buying gold miners and royalty companies that provide leverage. When gold goes up 20%, a well-selected mining stock might jump 50% or more. Second, they're heavily invested in specific tech stocks, but not the ones you think. They're not blindly buying everything. They're making calculated bets on three megatrends: AI infrastructure, not the headline AI companies, but the picks and shovels businesses providing computing power, data storage, and networking. Cloud computing and enterprise software companies with high-margin recurring revenue that compound silently. The semiconductor supply chains not just chip makers, but equipment manufacturers, material suppliers, design software. The key insight: they're not chasing headlines. They're asking, what does the world need more of in 2030, 2035, 2040, and buying those answers today while they're reasonably priced. The allocation strategy. The wealthy think about money completely differently. Most people think, I need to save for retirement. The wealthy think, I need to allocate capital across asset classes to maximize risk-adjusted returns. Here's a typical wealthy investor allocation right now. 30 to 40% in equities, not index funds, but concentrated positions in 15 to 20 high-conviction stocks they've researched. 15 to 20% in precious metals, gold and silver, physical and mining stocks. 10 to 15% in real estate, commercial properties, REITs, development opportunities. 10 to 15% in alternatives, private equity, venture capital, direct investments where asymmetric returns happen. 5 to 10% in crypto, strategic allocation to transformative technology. 15 to 20% in cash and treasuries, not for safety, but as dry powder. When markets crash and everyone panics, that's the money deployed at discount prices. Notice what's missing. Traditional bonds. The wealthy abandon them because locking up money for 10 years at 4.5% when inflation could spike makes no sense. But allocation is only half the story. The other half is timing. Different assets perform in different environments. In inflation, gold and real estate outperform. In growth periods, tech stocks dominate. In recession, gold shines and stocks get cheap. Right now, we're in a weird hybrid. Smart money is positioning for 3 scenarios: soft landing, recession, or stagflation. Here's the insight. In all 3 scenarios, having both tech stocks and gold makes sense. That's strategic diversification. The tax and leverage secrets. Here's what most people miss. The wealthy don't think about returns. They think about after-tax returns. Long-term capital gains are taxed at 15 to 20%. Ordinary income goes up to 37%. So when a wealthy investor holds a tech stock for 10 years, they defer taxes and pay the preferential rate when they sell. Meanwhile, savings account interest gets taxed at ordinary rates every year, drastically reducing compound growth. Over decades, this tax efficiency is worth hundreds of thousands or millions. And then there's leverage, the controversial tool most people fear. Simple example, you have $100,000 invested at 10% annually. After 10 years, you have $259,000. But what if you borrow another $100,000 at 5% and invest it? Now $200,000 grows to $518,000. Pay back the loan and interest, you're left with $355,000, $96,000 more. If you can borrow at 5% and invest at 10%, that 5% spread is pure profit multiplied by the loan size. The wealthy do this constantly. Portfolio loans at 3 to 4%, mortgages at low rates, while investing the difference, strategic margin use. They understand intelligent leverage isn't gambling, it's using other people's money to amplify returns on thoroughly researched opportunities. The information advantage. Here's what should make you angry. The wealthy have better information than you. Not illegal insider trading, perfectly legal advantages, personal relationships with CEOs giving nuanced industry understanding, exclusive conferences where business leaders share unfiltered thoughts, teams of analysts researching full-time access to private placements before public availability, hedge funds with sophisticated strategies unavailable to retail investors. This means they see opportunities months or years early. When they bought tech stocks in 2009, everyone was terrified. When they accumulated gold in 2019, media called it dead. When they bought Bitcoin in 2020, people thought it was a scam. By the time these became mainstream recommendations, they'd captured most of the gains. Time horizon and psychology. The most important distinction, time horizon. Most people think in years. I need to save for retirement in 30 years. The wealthy think in generations. I need to build wealth that compounds for 100 plus years. This changes everything. If you're thinking 5 years, you keep money safe in savings. If you're thinking 50 years, you recognize recessions are temporary buying opportunities. Warren Buffett said, "Someone is sitting in the shade today because someone planted a tree long ago." The wealthy plant trees constantly, investments that might not pay off for decades, but when they do, the returns are generational. Meanwhile, most people optimize for an extra 0.5% in their savings account. And here's the hardest part. This requires a psychological shift most people never make. You must stop thinking of money as something to protect and start thinking of it as something to deploy. You must become comfortable with volatility, seeing a 30% drop as opportunity, not disaster. You must develop conviction buying when everyone panics. You must embrace calculated risk, understanding that not investing carries the guaranteed risk of inflation. You must think in decades, not quarters. This psychological shift is why most people never build wealth, even with 6-figure incomes. The bottom line. Here's the brutal truth. If you're keeping significant money in savings while the wealthy stack gold and tech, the wealth gap will accelerate exponentially. The person who invested $10,000 in the S&P 500 10 years ago has $40,000. The person who kept it in savings has $12,000 over the next 10 years. That invested $40,000 becomes $160,000. The savings grows to $14,400. That's how the rich get richer, through compound interest working for them, not against them. You have a choice right now. Keep doing what you've been doing and accept you'll likely struggle financially forever. Or make the psychological shift, educate yourself, take calculated risks, and build real wealth. The wealthy aren't lucky or smarter, they just think differently about money, time, and risk. While you sleep tonight, they'll be positioning for the next wealth wave. Will you still be sleeping? Or will you be ready to capture those opportunities yourself? If this changed how you think about money, share it with someone still letting wealth rot in savings. We're all playing the same game, but only some of us know the real rules. Thanks for watching. I'll see you in the next one.